Joining us, Paul Nolte. He's a Senior Vice President, Portfolio Manager at Kingsview Asset Management, joining us today from the CME. Paul, we had a inventories number, but we've also got some strength in the dollar. Let's start with the inventories before we get to that elusive story for the greenback. What'd you make of the unexpected result here for crude?
You know, it's interesting because when you look at the crude market over a little bit of time, we've seen a rally from maybe the last summer lows to today. But the market's really been trending sideways for a while. So while we're seeing some general building in some of the crude price, in some of the crude to offset the higher prices, which is what we would expect to see as prices pick up, we've been in a trading range now for energy and energy stocks and crude oil prices now for the last 2-3 months or so. We're stuck in this $50 to $60-ish range. I don't see it going much higher. Don't really see us going much lower. So I think we're going to be range bound for quite a while yet.
So last time we had inventories number, it was a surprise. Today it was also a surprise. And I'm trying to figure out if the move in the commodity today is a result of that or if it's the green that we're seeing for the U.S. dollar. What do you think, Paul?
Well, you know, if you look at the commodity complex as a whole, you look at the Bloomberg Commodity Index or the CRB Index, again, same way. They've gone sideways. So we've seen some strength in the agricultural. We've seen weakness in the metals. Oil has been all over the place. But when you look at the inflation, underlying inflation numbers expressed by the Bloomberg commodities, it's been sideways. So when we start talking about the interest rate market and inflation expectations, we're not seeing it in the commodity prices. And it's really what we wanted to see in order to justify significantly higher interest rates, which we're really struggling to see right here.
Yeah, Paul, I'm having a little bit of trouble when I hear the explanation for weakness in commodities from the dollar climb higher, because guess what? The climb here, when you put it in perspective, is coming from a pretty short ladder. I mean, we're here at these depressed levels where the market was freaking out about, right? Oh, do we have these big picture fiscal concerns and debt concerns in the U.S.? And then suddenly it climbs up to 90.6 and, oh, all this commodity reaction explains it. Am I being too much of a cynic, Paul?
Not really. When you look at the dollar coming down from 95 down to 89, a jump to just over 90 is not a huge jump. If you want to take a look at it from the perspective, if you again step back from the chart a little bit and take a look at the dollar over the last couple years, we're probably in the second or third inning of a long-term dollar decline over time. The dollar tends to move in very long cycles, 5 to 7 years. We're 2 years into some dollar weakness. We think it continues generally lower over the next couple years. So the day-to-day moves, week-to-week moves, hard to guess as to the reasons why, but we think we're in a longer-term downtrend for the dollar here.
So walk me through why that longer-term bearishness can still take hold for the dollar, because just a week ago, I was reading a report from Goldman Sachs about how we shouldn't be concerned about those big picture, items that I just mentioned, the deficit and spending. What it's all about is just economic growth around the world, stronger than our own, tightening policy. And then I see a Bank of Japan that says very gradual raising. I see a Brexit situation that hasn't gotten any better, and a ECB that remains pretty accommodative by most standards. So what then is going to keep pressure on the greenback?
You know, when you take a look at it, and it's really more domestic. I think really if you take a look at it, the Trump administration would love to have a weaker dollar. It's going to help imports or help the export market, which they really like to see. We're not seeing it yet in the trade numbers, and that's a big disappointment. But I think behind the scenes, the administration would love to have a lower dollar and try to get the trade deficit actually a little bit worse, but work on those export markets much more than the import markets, which will create a little bit of inflation here. But again, that I think is really what can be behind the dollar. The administration has talked about it a little bit. Mnuchin has said weaker dollar is not a big deal. So you've got an administration that certainly is not dollar friendly here.
Paul, before we let you go here, I want to talk PMI day, because we've got our own Chicago number here, but we've got some around the world that are on the way. And because of that whole conversation we're having right now about the dollar and interest rates, seems like every economic data point is important. Is that the same case for these PMIs? What are you going to be looking at?
You know, the PMIs are going to be huge. We saw China last night, a little weaker than expected. We might see Chicago was a little bit weaker than expected. We could see a little bit weaker than expected numbers when they get reported tomorrow, and the services later in the week. Probably more emphasis on the service, only because it's 2/3 of the economy versus the manufacturing.
Yeah.
We're going to want to look behind the numbers and take a look more at the inflationary pressures behind those. And then, of course, the unemployment numbers next Friday are going to be huge, given what the reaction was to the last report.
All right, Paul Nolte, great to get your take here this afternoon. Looking forward to talking about these topics as they continue to unravel. Paul Nolte, Senior Vice President and Portfolio Manager at Kingsview Asset Management.